So, how can we identify a valid order block on the chart? An order block represents a specific area on the chart where a large amount of capital entered the market, usually from big banks or major institutions, often referred to as smart money. Because these participants operate with significant size, their activity tends to produce strong and visible price movements. When price accelerates sharply away from a particular level, like in this example, it often signals that institutional orders were placed there. Moves of this magnitude require heavy buying or selling pressure, and the zone where those orders were executed is what we call an order block. In general, order blocks fall into two main categories. Bullish order blocks are created by aggressive buying activity, while bearish order blocks are created by strong selling pressure. Once an order block has been clearly identified, it often becomes an area of interest because price has a tendency to revisit and react from that zone. It is common to see price return to the order block and then respond with a bounce or continuation. In this example, entering at the order block would have produced a favorable move, clearly illustrating how price can react around these areas. At this point, you might be wondering whether order blocks are the same thing as support and resistance. While both concepts are used to identify important price levels, they are not identical, and there are key differences between how they function and how they are defined. The first difference lies in how each one forms. Order blocks are identified based on strong and impulsive price movement away from a specific area. When price expands aggressively from a level, that area can be marked as an order block. Support and resistance, on the other hand, require visible reactions over time. If price rejects a level once and then rejects it again later, that repeated reaction allows us to define a support or resistance level. Another important distinction is the way these levels are drawn on the chart. Order blocks are usually marked as broader zones or areas, reflecting the range where orders were executed. Support and resistance levels are most often drawn as single lines. Even when they are drawn as zones, they tend to be much thinner and more precise compared to the wider zones used for order blocks. A third difference relates to how often price can interact with these levels. Order blocks are generally considered a one-time use. Once price returns to and touches an order block, it is no longer treated as valid. Support and resistance levels, in contrast, can be tested and respected multiple times before they lose their significance. Even though order blocks and support and resistance are different concepts, they can complement each other effectively. When an order block aligns with a support or resistance level, this creates what is known as confluence. Areas of confluence tend to carry more weight, as price has a higher probability of reacting when multiple factors point to the same zone. Before we can work with valid order blocks, we first need to understand how to correctly identify them. Earlier, we mentioned that strong price movement away from an area can point to an order block. However, it is important to clarify that this alone is not enough. A significant move by itself does not automatically confirm an order block. There are specific conditions that must be met for an order block to be considered valid. With that in mind, there are 3 key rules used to define a valid order block. These rules are essential because without them, it becomes very easy to mislabel random price movements as meaningful structures. The first rule focuses on the presence of a fair value gap. For price to qualify as an order block, it must create a fair value gap immediately afterward. This gap is often referred to as inefficiency or imbalance. Whenever you hear these terms, they are simply different ways of describing a fair value gap in price delivery. To make this clearer, let us look at an example. Here we have 2 price movements that appear very similar at first glance, as both move strongly to the upside. The difference becomes clear when we look closer. The example on the left shows a gap between the upper wick of the first candle and the lower wick of the third candle. In the example on the right, no such gap exists because the wicks overlap with the candle body. This gap is what defines inefficiency or imbalance. Even though both moves are strong, only the left example qualifies as a valid order block. To mark it, we take the candle just before the inefficiency and draw a rectangle covering the entire candle, from the highest wick to the lowest wick. The second rule is that an order block must remain unmitigated. In most cases, order blocks are considered a one-time use. Once price returns and touches the order block, even if it is only a wick, that order block is no longer considered valid and should not be reused. To illustrate this, imagine you identify a gap or inefficiency on the chart and decide to mark it as an order block. If price later returns and touches that zone, even if only with a wick, the order block is considered tested. Once tested, it is no longer valid and should not be treated as a fresh order block. Although there are approaches that reuse mitigated order blocks, those will be discussed in other videos. For now, the key idea to remember is that order blocks are generally treated as a one-time use. The third rule, and the most important one, is that a valid order block must lead to either a break of structure or a change of character after it forms. To see how this works in practice, let us look at an example. In this chart, price makes a strong move upward and leaves behind a gap or inefficiency, suggesting a potential order block. However, this alone is not enough to immediately draw the order block. We must first observe whether price produces a break of structure or a change of character afterward. At this stage, we can see that price has not yet broken the previous highs, meaning a break of structure has not occurred. Because of that, we wait and allow price to continue developing. Once price eventually breaks this high and creates a break of structure, that is the moment when we can draw the order block on the candle just before the inefficiency. In the next example, price again moves aggressively upward, creates inefficiency, and then follows through by breaking previous highs. Since this sequence results in a clear break of structure, it confirms another valid order block that can be drawn. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.